asked if we're going to get nuts and bolts. And I'm assuming a lot of people came in thinking this is going to be a lot of nuts and bolts. And we do get to a lot of nuts and bolts. And the rest of this is nuts and bolts and dry. But I can't start the conversation without actually getting to what it is we love and discussing our passion, discussing our values. I can't begin the process until we get that out of the way. And not out of the way. We should return to that constantly. And then we get nuts and bolts to support the groundwork that we have to do. And there's a second thing that I completely forgot about. Oh, your question. So the question was asked, if you want to work with someone like us, there's a lot of designations. You can have a CFP. You can say after my name at the beginning it says CPWA. There's AIF. There's probably 50 different designations. The most well-known and well-marketed one out there is CFP. Okay, the next one is probably CIMA, C-I-M-A. CFP is general planning, budget, saving. So the ones that are behind my name, I do not have a CFP. I never saw the need for it. Most of my clients are of higher net worth kind of folks, and I have a CPWA. And if you take a CFP and take out budgeting and add like business transfer planning and these kinds of things into it, you get a CPWA. So it's a different goal set. And the AIF, if you ever look for somebody, you should actually look for, I think, someone that has an AIF, because that's a fiduciary. So the big question you have in front of Congress and Frank Dodd and that I think that the broker, the Wall Street lobby is going to kill, they've killed it for 20 years, is the fiduciary standard for anyone that sits in front of a client. And that, I doubt that's going to happen, because the last news that came down was that it's not going to happen. But they've been told to continue thinking about it. The SEC has been told to continue considering it. Doesn't look like it's going to happen. Call your congressperson and say, fiduciary responsibility is an important factor. Otherwise, someone that sits in my chair can just sell you whatever product pays them the most. Standard Wall Street. AIF? AIF, yes. I don't even remember what it stands for. The last F, fiduciary. So we're going to get into some nuts and bolts. And I'm going to try to make this fun. I don't know how it's going to happen, but okay. So the first thing in the save category is we're going to talk about cash management. Okay? So while we do this, we're going to understand the steps to setting some financial goals, track some spending, and you actually have a little workbook in here as well. And we're going to do little exercises. Prepare a spending plan, identify ways to decrease spending, identify ways to increase income, and then pay yourself first. If there was one thing that I could tell 99% of all of my clients, 99% of anyone I meet, is if you want to be financially successful, you have to live within your means while paying yourself first. Okay, if you can do those things, you're done. Everything else is detail. Ah, here it is, SMAC. See that? Right there. SMAC certified. How do you do a financial goal? Specific, measurable, achievable, consistent. Organize them. What I mean by that is prioritize them. So when I sit down with a client and we start a financial planning process, we go through a lot of questions about what is it they want to accomplish, what are their goals, what are their milestones, where are they starting, and then we start doing the trade-offs. Okay, you want to retire when you're 27, that's cute, not going to happen. So what are you willing to, what do you have to give up to make that happen? Well, you could move to Mexico and live on the beach in a tent, and then you could retire when you're 27, if you wanted to. I'm not willing to do that. Well, then we can't retire when you're 27. So what are the trade-offs? So we want to prioritize those goals. That's what we're talking about here. Okay, so a spending plan is a simple step-by-step plan for meeting expenses. Okay? And what we do is we set a period of time. We talk about income flowing into that. Okay, right inside the first exercise, you've got daily spending diary. Has anyone ever done this? Like written down everything you spend in a week? Is it shocking? We go through this exercise with every single person that comes to the office. First, we send them out a packet and ask them to answer a bunch of questions, knowing they're not going to look it up, right? They're just going to answer, they don't want to spend the time. How much do you spend on a monthly basis? $8,000. Okay, great. And then we come in and we get their statements. You realize you said you spent $8,000, you spend $12,000. And they're like, wow, right? Every single one is shocked at that. But it happens 99% of the time. So we all suffer from this. We call it leakage, right? We have a hole in our pocket and money just kind of leaks out of it. And I think it leaks into things like coffee and lunch and dinner with friends and, shoes, depending on the family. So what you do is you have a daily spending diary and just track it. And if you do this for a couple weeks, you get a good sense. And then in a couple months, you stop, and then you do it again, and you'll see that leakage has, again, come up and it's raised its ugly head. And then you have to consistently monitor this. And then eventually, after you do it and do it and do it and do it, suddenly it doesn't happen as much. But you have to train yourself to pay attention to this. So everyone knows what income is, right? All the different sources of income. So has anyone ever, I won't ask you guys, I've been on public assistance. I've been unemployed. So I received an unemployment check. Anyone else? Oh, my people. So there's a conversation happening, in our country right now. And I'm sort of right here speaking, I'm guessing you guys are in Berkeley, you're preaching to the choir a little bit, right? There's a need, we should probably support the need. So in this whole budget, we don't have enough money, I have benefited from it, I say raise my taxes. Simple as that, I agree with Warren Buffett. Anyway, that's a totally different presentation. So we get income from a lot of different places. So does anyone here give to their kids or receive from their parents that annual gift? Okay, that makes ends meet, right? That's fantastic. So we get it from my wife's father, and it's wonderful. It counts as income. It's not taxable, and you should include that in your analysis. Something we try to do is we try to take that money or half that money and just save it immediately. So do you know what your gross income is? It's your total income, and then income minus deductions, right? What kind of things go into your deductions? So this is out of your paycheck, right? Your FICA, your Social Security, that's FICA, if you have health insurance, sometimes that's deducted out. These kinds of things go into the deductions. So when you think about expenses, we try to break them up into needs and wants, right? And some things that are wants are flexible, or some things that are needs are flexible. Most of the time we look at those things that are flexible expenses as wants. And when I sit down with people and we ask them the question, what's a need, what's a want, the line varies. For some people, their iPhone is right? Right, sometimes it's a need. I would say the iPhone is a want, because you can get a free phone from anyone for the $19.99 plan. You don't need an iPhone. But in our culture, maybe you do. Maybe there's a status, maybe you need that, I don't know. But every person has a different line. The important thing is to know where your line is. And then when you're making those decisions, don't make that decision with your limbic brain, make it with your frontal cortex. So basically what this is a 2009 Consumer Reports survey on what people spend their money on. So this is national average. How do you think it would be different here? Let's just do that. What would be different here versus a national average?
Housing more.
Housing.
More.
Gas is not going to be that much more, but housing is definitely going to be a lot more. I think the big one is the housing one. Housing is much more expensive here than it is across the country. The average house is what, $550? National average is $250, right? So huge difference. So you're going to see this number right here. This says 34.43%, right? It's going to be more like 45% out here. So you're going to spend a lot less of your income is available for these things. So is that factored into your decision making? I'm going to live in a place where it's more expensive. Does that, before you say you're going to live here, do you think, well, that means I'm going to take less vacation? Does that mean I'm going to not buy as many new clothes? It doesn't. We don't think about that. But we've made a choice to live here, and it's really expensive to live here. And so if we know that, and we've made that choice consciously, we should be aware that there's a trade-off for that.
It's much cheaper to fly to Hawaii. There you go.
You can go more times if you fly from Hawaii from South Dakota, though. Yeah. You can go a lot more times. So anyone that wants this, if you contact me, I'll actually break these percentages down and just send them to you in an email or something. It's actually interesting to compare how you spend money relative to how the world spends money. And you can see where you differ. And I can tell you right now, you all spend more on rent or your house payment than anyone else in the country, unless you're in Manhattan. So monthly income and expense worksheet's the next thing. So we force everyone that comes to our office to do this every year, right? And when they love it. Because it always gets out of control. People always spend more than they think. But it's also important that you have income sources. People don't often put in that gift from mom or dad. They don't put that into the mix. And that counts, right? It counts as income. Dividends count as income. I don't think you should spend that income, but they count as income. So you put them in there. And you can kind of see a sample here. So this is something you can do here while I'm talking. I don't mind. I take no offense at that. Or you can go home with your partner, with your spouse, with your friend, and do it with them. The idea is just to take account of everything on a regular basis, compare it to history, and then you can start making decisions from the top of your head, not from down here, about ways you can change that. There's an article that's recently about, it says $15 or $37, chump change is sort of the title of the article. And what it is it says if you're 25 to 40 years old, you spend $3,500 a year on coffee and lunch at work. Does that seem about right? I think about it, it's about right. Now, if you're 45 to 60, you spend about $1,800 a year. You spend about half that because you've learned, or you've thought about it, you've planned, you've realized that, gosh, and I think there's another corollary to that. I think it's because you're not trying to impress anyone anymore, or not as much. I think you still try to impress people, but different people. Okay. So what other ways can you curtail spending? Coffee, $3.50 latte. Cable. What about when you go to the ATM? How much money do you pull out? When I was a student, I pulled out 20 bucks when I went to the ATM. Now I pull out 200. It lasts about the same amount of time. Right? If I just pulled out less, I wouldn't spend as much. That's for dry cleaning. You laughed. It's dry cleaning. Touche. I had it coming. Okay. There's a lot of ways to save money. And if you just think about it, you can come up with those ways. And this is what we were talking about earlier. How do you increase your income? See, almost every planner I know tells people, okay, this is your income. Don't spend as much. You'll get there. I don't think that's enough. I don't think it works because I sit down with people whose kids are in private school. And this is not a judgment against public school or private school, but if you've made that choice and you're a teacher or you don't have any other money. So if I tell them, listen, you have to put your kids out of private school, they're going to be like, forget it. I won't retire. I'll work for the rest of my life. So the other options, if you're not going to cut expenses, if you're not going to take cheaper vacations, if you're not going to size down your house, is to have more income.
Rent a room.
I have a client who retired from, he ran a construction company, he retired, he rents 2 rooms in his house because that enabled him to retire sooner because construction was killing him. And he grows raspberries and sells them to all the different bakeries. Wow. Right? So you can come up with ways to make money. The one that we talked about today is just one way. And he loves growing raspberries. He has an incredible farm in Oakland that grows raspberries. It's amazing. Okay. So these are some of the things, some of the sort of rules of thumb. Keep your tax records for 3 years. Keep all your records in place. So is anyone, this is an earthquake preparedness question. Does anyone have their stuff in a place they can grab and take with them? Only 1. 2, 3, 4. Okay, see, you ask twice, more people answer yes. That's interesting. What if anyone else? No, okay. So there's actually what you can do is you can take, your file cabinet should be the second step. The first step should be a little manila folder with this month's, boom. And the reason you do that, or I guess your iPhone could have this information as well if you can remember to grab that. But if there's an earthquake or something, you need to be able to call your credit card companies and say, it's missing, it's in my house, I don't have it, something's wrong. You need to have that contact information so you can call those people. You need to be able to call so who here rents? Okay, of you that rent, which is the majority of you, how many of you know your landlord's phone number? By heart. Right. You don't? You don't? Seriously? I'm going to call her and tell her that. The fastest growing crime thing right now is computer theft, hacking. I think you should always have easily accessible your last credit card statement, your last 401k statement, your last brokerage statement, your last bank statement, so you have what it was worth. And now, in my file cabinet, I purge it every 7 years. It's very heavy and large, but I have a place where I have all that information in there. And I have an app. You ever know Mint? Okay, so Mint can actually track most of this stuff. I don't know if Mint has a vault, but you may be able to upload. Does anyone do they have a vault where you can upload documents in Mint? I don't.
I'm not familiar with Mint.
Mint.com. It's a place where you can log in and you can add your bank account statements, your 401k, all your financial records, your monthly payments. You can put everything in there. It tracks your bank account. It tracks everything for you, and you can just pull it up on your iPhone or your Droid if you're so inclined. Yes.
I'm still using money. Should I switch?
Say it again. You're still using money?
Yes. I like money.
Cash?
Microsoft money.
Microsoft money. That's what I thought. Because I think we're all using money. You know, so there's people, there's no, if you have a process that works, use that process. I mean, I have clients that use Excel spreadsheets. I actually have clients that bring in wildly complex Excel spreadsheets that are way more complex than financial planning software. It's just awesome, right? They have it under control. They know what they're spending. They know they can track things. I want you to have the information so that you can make calls to your credit card company saying, you know, my house is demolished. I'm not sure if my wallet was in my car or if it was here. I don't know where it was. You know, I was at work. I was somewhere else. And I need to know that this is going to be safe information. So put it on watch, right? But it's not that I'm trying to get that money out or I'm not trying to get access to it, because that's going to be a problem number two. I have a buddy of mine who's a complete crazy person, but he says, you know, wad of $1,000, put that, you know, in a shoebox, and that'll be helpful. And maybe it's 100, maybe it's whatever it is. Having a little bit of cash somewhere in the house, probably not a bad idea, just in case for that reason. Monthly payment schedule is the next piece, and basically what this is this puts it in your brain when you're expecting to make those payments, so that you don't overspend before that payment is due. In a little bit, we'll talk about different methods, right? Someone mentioned money. We talked about using Excel spreadsheets. There's other methods, right? If you deal in cash, there's an envelope method where you have your weekly bills, you put them in those envelopes, and you put the cash in the envelopes as the cash comes in. That way your bills never fall behind. Because this is one of the things my father works on, and he's still in South Dakota, is people get their power shut off for a $19 energy bill that they don't pay for. Then it costs them $75 to get the power turned back on. And if you miss it once, and you're of that kind of low income, you're in trouble, right? So anyway, this is the monthly payment calendar. So once you have the payment schedule, right? The next thing you do is you put these pieces on a calendar. That way you know, and you'll know some of them will vary. Some will be the third Thursday, some will be the first. You'll know when these things come due. And this is mainly for the folks that are that 30 years and under that are getting this under control for the first time. But these are just tools you can use to manage the income and outflow. So this is what I talked about a moment ago, the expense envelope system. There's also a budget box system. And what the budget box system is it's a box with 12 monthly folders in it, with 30 or 29 or 28 or 31 days in every folder. And so it's a big box with a lot of things in it, but something comes in, it's due such and such day. And anyone can use any kind of computer spreadsheet systems, they're fine. The point is, whatever system works for you, use it. I mean, if paper works for you, use paper. So what do? Expenses are greater than income. Does this happen to anybody? Yeah. So there's necessities. You buy food, you pay rent, unless you talk to a landlord and they're good about it. I don't know many landlords that are that way. You pay your mortgage. The non-necessities, those can wait, right? Which means if you don't pay your PG&E bill, they may turn it off. It may cost you $75 to turn it back on. Ideally, what you do is it takes a village, is you have a friend that can support you. I have one friend who, actually we went to school here together. He was an Institute of Buddhist Studies student, and I was an Institute of Buddhist Studies student. And I'd be short $50, and he'd say, here's $50. Then he'd be short $50, I'd say, here's $50. And we have no idea who owes who what. But sometimes I didn't have a job, and sometimes he didn't have a job. So hopefully, you're not all completely alone. and you have somebody you can actually go to. Because ideally, you pay your bills. And then if you have someone that can support you, and there's a ton of, and this is not what this talk is about, but there's a ton of organizations. Does anyone know what the quarter meal is in Berkeley? So Berkeley Food and Housing Project puts on a quarter meal. And the reason it's called a quarter meal is because after the Great Depression, it was a quarter, right? Now it's free, which means that's sort of the opposite of inflation. But so you can go, I think it's 5 o'clock any day of the week, and there's dinner. And what's the Episcopal Church? No, the church. It's south of campus.
St. Mark's. St. Mark's.
Is it St. Mark's? Yeah. So and there's a lot of different places in Berkeley, especially where you can get a meal. So there are places you can go to reduce expenses if you need to. And I think I would have an incredibly difficult time doing that if I needed to do it. Right? I might take my kids there and feed them, but I might not eat. Right? I don't know why. It's just pride, probably, stupidity, maybe. But there's a lot of resources, especially in our community, that one can tap if one is in that situation. Hopefully you have friends to support you. So here is, if you're having trouble paying your loans, pay off the high interest rate one first. There's actually another, this is not in here, but there's another way that people think about this, and that's, let's say you've got 4 credit cards, and you've got one that's a higher interest rate, one that's a low interest rate, 2 that are normal interest rates. So there's one school of thought that says pay the high interest rate one off first, right? Because it's most expensive. There's another school of thought that says pay the one off, so you have your payments on all 4. You have to make payments on all 4. Pay the one off that's got the lowest balance first. Then apply the payment you were making on that one to the next one. So what that does is it forces you to keep your payment level at the same level so you can actually pay it down faster. Right? So a lot will depend on the rate that you're paying. If you've got a 25% interest rate card, pay that off. That's insane. So you remember this?
Yeah.
Okay. See the difference? Oh, you don't see the difference. I'm trying to block you. So, right? So that's ultimately the goal, right?
So it's going in the direction of Mitt Romney.
You know what? Ideally, we should all be there. So ultimately, we're all going to be there anyway. We won't have that kind of income. But again, like you said early on, there's a point in our lives when they don't let us work anymore. They won't hire us, or unless we write books and we are, what Mike Van Horn suggested, unless that's our income source, we don't control that. And so we have to at some point be here. So remember what we said early on in this is you got to live within your means and pay yourself first, okay? Nothing more important than this. So did anyone's parents tell them when they were growing up, you have to save 10% of everything you make? Okay, 1, 3 people nodding. Anyone else?
Oh,
4 or 5 people.
10% to the church, 10% to the bank.
So you know what I teach my son? My son is a third, a third, a third. You get to spend a third, you give a third away, a third of it goes into savings. He's 7, so we'll see how that... He doesn't make a lot of money, so his allowance is $3. So okay. So we know what it means to pay yourselves first. You put your money in savings before you pay your bills. So that in that box system or in that envelope system, the first bill is savings. Okay? With your first paycheck, if you just give 10% of it away, put it in savings, auto debit it, make it go someplace else. Make it so your paycheck has a debit on the paycheck. Talk to your employer, say it goes to this account. This is the spending account. And you'll be fine. So I have someone that works in the office. She turned 30, and she said, so we match a 401k in the office, and she said, well, I'm going to put in 2. And I'm like, I'm matching you 5 if you put in 5. It would be insane for you not to put in 5, because I'm going to give you money if you don't put in. If you put in 5, I'm going to match it. Okay, 5. And I was like, you know what? And it'd be really, really good for you if you put in 10. And so she upped it to 10. And so she's young. She's not making a lot of money. But she can make it work. And we can all make it work. It's just one thing less, right? It's just one thing we can do less. And that will pay off in huge ways in the future. The other thing, as terms of why, is habit. If you start with $5 a month, which is nothing. In fact, that's a dumb statement. If you start with $20 a month, even that's nothing, right? $20 is $5 a week. you can make a difference because you build the habit. And then the next, your spending changes to incorporate that $20. And then as your spending changes, you make it $40. And your spending changes, you make it, and then you get a raise and you commit that to savings. So when you're starting out, maybe you don't have enough, but you can save. You can save and you need to build the habit. And the habit is, it's just like going to the gym. It's just like going for a run, going for a walk. You have to have the habit of savings. So when the bills are due, you have to pay them. That's not an optional thing. So the only thing I say is save long enough to build up a reserve so that you can tap the reserve when you need to, okay? And that reserve can be taxes. I like to see people save in a separate account for taxes because that's going to be costly, right? You can't get out of that one. But have a reserve, and then everything beyond the reserve, and we'll talk about this in a second, goes into more an investment kind of a situation. But everyone needs to have a cash reserve. The number one cause of people like losing their houses it's when you don't have a cash reserve and you get sick and you can't go to work, and we all get sick, right? There's no way to avoid it. We're going to get sick. In May of last year, I broke my leg. So I had someone in my office drove up the hill, picked me up to work, put the leg up on the desk, did the work, drove me home, because it was my right leg. You can't drive without a right leg. Drive without your left leg, not your right leg. So that happens. It happens to people that are incredibly healthy. You get sick, you get injured, and you don't get income. So you have to have the reserve. The reserve is the first step in planning. Someone comes to my office and says, oh, I'm making all this money and I want to start investing. And I say, okay, how much do you have in your reserve? You need to have 6 months in your reserve before you start investing anything. Okay? This is a great question. Is it better to take money out of your IRA or to take a student loan out? What I would say is there isn't a stock answer, right? Every individual is going to be different, and every situation is going to be different. So when I was in college, the thing I was looking at doing, because remember I bought my first stock when I was 9, was I was borrowing my student loan money so I could buy an apartment building that I lived in, right? But then I rented rooms to people. So that's what I think. I have no problem with borrowing, especially when it's subsidized. The question becomes if it's unsubsidized, then it's a different question. But if you can get subsidized money, they're going to pay for the interest and the stuff, and you get deferred payments until you graduate. I have no problem with that. Now, OWS, everyone know who that is? Occupy Wall Street. So one of the big problems that Occupy Wall Street is talking about is the high rate of student loan debt and the cost of that debt after you graduate. So on an individual basis, we got to figure out what that threshold is. So I'm not saying borrow, but some things you have to talk about when I talk with clients is you want to build assets, because if your assets grow, your IRA, if your assets grow fast or faster than the rate of interest on your debt, your net worth is improving. So you don't want to drain your assets and so you can have no debt. There's a combination of the two that works for every person, and I don't know what the combination is. Right? Does that make sense? Everyone get that? Okay. And that's true not just with student loan debt. That's true with all debt. Student loan debt's nice because you get some subsidization. Is that a word? Subsidy. You get some subsidy to support it. Okay. The Pay Yourself First worksheet. So you write down some savings goals and some strategies to save for it. So where's the money going to come from? What are some of those goals? And then the next page is some decision factors and an action plan. So how much you want to accumulate over a certain period of time? How long can you leave it invested? How do you feel about taking risk? And this will actually inform the tools you used in savings. There's a big difference between savings and investing. Okay? So what we just said was, before you invest a penny, you need to have 3 to 6 months of living expenses in a bank account. One of my favorite planners in the world, and this is on camera, said that's your FU money. So let's say you get sick and you need that money. Well, that's one way. But let's say you walk into work and your boss for the 8th day in a row has just reamed you. So this is the money you say, listen, I'm not coming in tomorrow. And now you go find another job. Right? So that money is good for lots of things. It gives you a sense of freedom, a sense of control of your own life. You're not dependent upon people. Now, you don't want to build into that you have this habit of leaving things because it's hard. Because you got to work through. Life is hard. Sometimes it's difficult. So, balancing act. So everyone knows what interest is, right? Right? Okay. Does anyone know what compound interest is? What is it? Give me ideas. What? Interest on the interest. I call it the eighth wonder of the world, right? It's
how Warren Buffett made his money.
That's it. So that is my favorite person because he is no nonsense. Yes, I owe more taxes. Listen, Wall Street's a bunch of jerks. He tells it like it is, and because he can, right? He doesn't owe anyone anything, so it's good. He does have a lot of FU money. That's right. And he doesn't have a lot of time to use it, so we can just use it all he wants. So eighth wonder of the world. So this is a lesson my father taught me when I was just really young. And the way he taught me was with something that we don't even have access to anymore. Remember a passbook savings account? They don't exist. Not even at the Cooperative Center Federal Credit Union. It doesn't exist in Berkeley. And what it was is as a little kid, I'd go in and I'd give my money to the banker, dollar, and I'd go back in and interest rates a little higher, 1980, 15%. So you could go in and you'd come back the next month and you'd made a penny on that dollar. Right now you'd make a penny on $1,000. I mean, there's no interest right now. So, but they don't even have passbook savings. So my kids can't engage and see that. So what I did is I actually built my son, my daughter's 4, she's not really engaging on this level yet. I built him a passbook savings account. So we have jars, and the jars all get interest. And so we're sort of training. I pay a little bit more than a bank, but not much. Do you ever know what an APY is? It's when you take the interest rate and apply it to a whole year, what you can expect right? So this is the kind of thing that a bank has to report to you if you're going to get a home loan. They have to give you what the annual percentage yield is. Okay. Now I really want to focus on this because I think this is funny. Right down here, this is a mathematical concept and does not guarantee investment result or function as a prediction of how an investment might perform. Are we clear? So Eric knows this. So when I create a presentation, I submit it to attorneys, and they told me I had to put that there to show this because you might not understand that this is just math, not an investment. It's just unbelievable. So a formula that lets you estimate how long it takes for money to double. So 72%, 72, rule of 72, divided by 4, 18 years. Or divided by 12 years, you need a 6% return. So if you want your savings account to double in value in 20 years, what interest rate do you need? Just quick.
5%.
Well, you're at a humanities.
30.
I am at a humanities school, that's true.
36%.
3.6. Well done. You said 36, but just a decimal problem. It's okay. So this is just a way to see, okay, I got $40,000, I'm trying to get a down payment on a house, how long is it going to take me to do this? Nice little rule. See down here? Before you invest, savings cushion covers 6 months of normal living expenses. I say that on this because here we're talking about, and we're going to just go over some definitions. We're not actually going to spend a lot of time on how to invest. We're just going to talk about tools one can use. So open savings account, invest money. The difference is not federally insured, right? So this one's not insured, this one's guaranteed by the feds. So here's a couple tools, a few tools. Bonds, ETFs, mutual funds. And then there's some buckets you can put those tools in, retirement accounts and stocks. ETF is an exchange-traded fund. It's a basket of stocks you can buy all at once. Sometimes it's an index or it follows an index. Mutual fund's kind of the same thing, but it has a manager that makes decisions on which pieces they're going to buy. Okay? Any other questions on the?
Who makes the decisions on the ETF?
The ETF is designed to follow an index.
It follows an index.
So there's no manager. So ETFs are cheaper usually. So does everyone know what a Treasury Security is? What a T-bill is?
No.
T-bond? So this is what, when you talk about the Treasury auctions the U.S. government has, when they talk about $1.3 trillion deficit, this is where we get the money to fill that deficit on an annual basis. Okay? So we sell T-bills, which are short-term, T-notes, where they're up to 10 years, and T-bonds, which are 10 plus years. Okay?
I don't even know where you buy them. I was trying to figure that out one day.
You can buy, I mean, you can buy, almost banks you can buy Treasury bills from.
Really?
You can actually buy Treasuries direct from the Treasury. So you shouldn't go to a bank or a broker to buy Treasuries, because you can get them direct. I think it's treasurydirect.com actually, right? So TIPS, does anyone know what a TIP is? Treasury Inflation Protected Security. Okay, very, very, very quickly, there's an equation that goes with a TIP that says if inflation goes up, you get an added kicker when you get the bond back. So it protects you from the declining value of the security if rates go up. Does that make sense? We don't want to go too deep into this. We'll talk more about these kind of things March 9th. Okay. Corporate bonds, same concept, not guaranteed by the government, guaranteed by the corporation issuing them, right? So a little bit, not quite as strong, unless they're Warren Buffett's company, Berkshire Hathaway. Very similar. Or Apple, actually. Stocks, equities, everyone knows what that is? Share of a company, right? You get the dividend on that share, you get the voting rights on that share. You're an owner in a piece of the business world. Sometimes dividends go away, sometimes they're reduced, so there's no sort of expectation. You do expect it when you buy it, but sometimes changes happen. One of the things that happened in 2008 was the banks were forced to eliminate their dividends. So if you had built a portfolio, and your income stream based on bank dividends, not good for you. IRAs. Does everyone know what an IRA is? We had a comment about an IRA earlier. Do you liquidate?
No.
An IRA is an individual retirement account. See how it says? Basically what it is, it's a way for you, not a 403B, not a 401K, which is what you get through an employer, to get a tax deduction to save for your retirement. Okay? They also have educational IRAs. They've got other tools you can use to get tax breaks. So you see here we've got traditional and we've got Roth. So the difference here is a traditional IRA, you get a tax break today. When you pull the money out, you're taxed on it as ordinary income. The Roth is you get no tax break today, but then when you pull the money out, you're not taxed on it. So, and then, the last 5 to 10 years, there were a lot of shenanigans, a lot of talk about, oh, we should convert your Roth into a traditional Roth and convert it back, and you can reconvert it and unconvert it and stuff. And all that stuff is noise because we have no idea what tax rates are going to be in the future. Right? It's a nice bet. I always say to people, have your 401k, which you can roll over to a traditional IRA, and fund a Roth IRA. Just do them both. That way, when it's time to take income out of them, you have some control over the kind of income you take. Right? So you control your tax level somewhat. So the question is, why would you do an IRA versus a savings account? I think there's 2 reasons. The first reason is the obvious one, you get tax benefits for the IRA. Okay? Second reason is you can get into money in your savings account really easily. And so if there's the line that you draw for, I need to withdraw money from a savings account, is a very low bar, low hurdle to get to that. Right? Your IRA, you get penalized for pulling it out. So the federal government, if you put money in an IRA, will charge you 10% if you pull it out before you're 59 and a half. It's designed for retirement. Same is true of your 401k, right? If you put money in your 401k, you liquidate your 401k, you get taxed on it. In addition to the tax you owe, you get a 10% penalty. Oh, I don't want penalties. Yes, but we're also dealing with behavior. And behavior is 9 to 1, the most potent part of your financial success. It's not how your investments do. It's not whether you choose an IRA or savings account. It's how you behave. So choosing an IRA helps you manage your behavior. Because it's better. I have liquidated an IRA once in my life to start a business. So I've done it. And there's a time to do it. I've got clients that said, I'm in night school, I'm thinking about changing to the day program, it's going to cost more money, should I go into my IRA to do that? We crunch the numbers, it makes sense. So there's a time to do it, but we want to manage behavior. 401k, 403b, this is an IRA that's hosted at a company. It's tax benefits, but the nice part about the 403b, 401k is it's monthly out of your paycheck before you see it. That's critical. It's so important. Who has a 401k? And who has a 401k that's not contributing? Oh, that's really bad. You're fired. No. I mean, just go back to the office and set it up for maximum contribution. I don't know her at all, and that's the one thing that I think everyone should do: max out your 401k.